Right. Once again, good morning and good afternoon, everyone. I hope you are doing well. The weather is nice here today. I'm connecting in from the Philippines, and I hope that it's nice also where you are from. I'm actually curious and just wanted to check where you guys connecting from. Yeah, so I let us know in the chat box below. Oh, I see people connecting in from Singapore, connecting in from the Philippines. Hi, hello, kababayan, and people connecting in from Malaysia. Oh, actually, in the chat box below, there's a drop-down tab that allows you to send or to select between hosts and panelists, and also everyone. So make sure to click on everyone so everyone here can see your chat. So once again, welcome. Hi, Rochelle. Hi, Yonji. Hi, Dave. Thank you so much for joining in early, and we'll be starting in a few minutes while we are waiting for the bulk of the audience to join in. Oh, we have people connecting from Australia. Hello, hi. Good afternoon. I hope everything is going well in Australia. Yeah. Yeah, and also, yeah, I think a bulk of our audience are connecting in from Singapore. Well, I think we have a really diverse set of audience here today. And yeah, maybe we can go straight into it. All right. So once again, hello everyone, and welcome to our webinar today, where our goal in our webinars, especially in this session, is to introduce you to people and ideas that can help you play the long game for a successful fundraising and growth. So I'm Joel from E27, and this is Keeping the Lines Open. Coming to this webinar, I'm sure you've heard of the term VC, as in venture capitalists. So I'm not sure if this is true, but a friend told me before that VCs actually like their startups like how they like their fish, scalable. Get it? As in, because you can scale a fish, scalable? No. No, anyway, so together with our friends at Cake Equity, we invited some of the most amazing thought leaders to share their insights on how you can ensure a healthy investor relationship for future funding success. But, I will see the details of the discussion to our panelists later on. Now, before we start, let's just go over a few house rules. First, do note that this is a panel discussion, and we would like to invite you to join by sharing your thoughts and comments on the topic in the chat widget below. Second, the floor is always open to your questions, so please do share your questions in the Q&A widget below as well, and we will get back to it so the panelists can address them at the end of the discussion. And lastly, with the first two house rules in mind, please note that this webinar is recorded and will be shared with all of you via email after. Now, before we dive into it, we would actually like to get to know you more. So I know there are people coming in from different places around the globe. So we will be launching a poll on your screen to get a sense of who you are and where you are coming from. So let me just, yeah, so there's a poll on your screen, and we would like to invite everyone to share your thoughts with us. So the first question is, what has been your biggest challenge in fundraising to date? So that we have four options here: meeting the investors, maintaining contact, identifying and also pitching your company. And the next one is, what is your main focus in the next 6 months? So I think this is one of the most, really important factors that you need to factor in, especially when doing your startups. So we also have four options here, and you'll be opening this poll for a few more seconds. But I do see that for the first question, the first, you know, the most voted one is meeting with investors. Wow. And then the second one is, oh, don't worry, we will be sharing the poll results with you in 3, 2, 1. Okay. Yeah, so as you can see here, there are a lot of people, having troubles in meeting with investors. And also for the second one is, their focus is mostly on fundraising and building investor network. Yeah, I think this two goes hand in hand, right? Yeah, maybe share your thoughts with us on the chat box as well. Yeah, and thank you so much. Thank you so much for sharing your thoughts with us. And yeah, now with all of that out of the way, I would like to turn over the floor to our moderator, Mohan. So Mohan is an all-around person with a bright vision to help startup founders build and grow their companies. So enjoys working with startup founders. Mohan helps them alleviate the challenges of building a great company, as he believes their startups can make the world a better place. So please, help me in welcoming our moderator for today, the founder and CEO of E27, also dubbed as the rebellious entrepreneur, Mr. Mohan Belani. Hi, Mohan. Pleasure
Hey,
to have you here.
Joel. Thanks. Oh, I need to
Woo!
learn from you how you make such good jokes. I'm going to definitely copy that for some future event. So yeah, that was a good one. Okay, so firstly, thanks to my entire team for putting this together in partnership with Cake Equity. So it's a very opportune time for a topic like this. If you're a founder raising capital, if you're an angel investor looking to invest in companies, I think this is a very relevant topic for today. I would like to welcome all the panelists. So maybe can the panelists turn on the video? So we have three panelists. We have Charlotte, who's the co-founder and CEO of Jackett. So she represents the founder personality persona. We have Carlos, who's the investment manager at Qualgro. He represents the investment persona, and we have Jason, who is the co-founder of Cake Equity, the platform that works together with startups and investors. So can we do a quick introduction from each of you, a bit more on your backgrounds, some context to the discussion as well. Maybe we can kick off with Charlotte, followed by Carlos and Jason.
Sure. Thank you, Mohan. Hi, everyone. I'm Charlotte, co-founder and CEO of Jackett. We're a Singapore-based startup, but we're a global company. We're an operating system for personalized education at scale. So our technology enables educators across Asia and Africa at the moment to deliver personalized instructions and assessment across the tuition sector specifically.
So edutech company then.
Yes.
Great. All right, Carlos.
Hi, everybody. I'm Carlos from Qualgro. We're a Singapore-based VC that focuses on Southeast Asian tech companies. I think, one of our biggest things is that most of the senior management of Qualgro is made up of either ex-management or strategy consultants or operators of startups themselves, including myself. So I think we do have a lot of value to add to our portfolio companies. We typically invest at Series A and B, sometimes a little bit earlier, sometimes a little bit later. Check sizes range from anywhere from 2 to 10 million usually for first check. Yeah, that's basically us. Quite vertically agnostic, I would say as well, but more product focused.
Great, thanks, Carlos. And Jason?
Awesome, thanks, Mohan. Great to work with you on this event. So yeah, I'm Jason, one of the co-founders of Cake. Cake helps startups with their equity management, of course. Our focus is working with seed to Series A startups, so sort of from pre-seed to Series B. So it should be really relevant for you all today. And then we grow with our customers. So as you scale, Cake scales with you. We especially work well with startups with global teams, as Cake can manage your equity plans in over 30 countries now. We've got all the legal agreements built in, which was something cool and unique that we did to help founders, which makes equity better than ever, especially cross-border. So yeah, we've got 1,500 startups using Cake now, and around 100,000 of their investors and employees on the platform. We do a lot of work in research and content development to help founders and their teams to use their equity well, including this event. So yeah, just here to help with everything we learn and share as much information as we can.
Great, thanks, Jason. I mean, founders, especially in this testing time, could really do with a lot of the help, right, that all these platforms provide. So great to have you as well. So some of the top level talking points we're going to be discussing today, what are the fundraising challenges? How do VCs, make decisions during this period? How to continue to have open communication with investors, and what are some of the best tips you can do to alleviate during this point? I have a list of questions prepared, but I would highly encourage all of you who are joining us today to also be asking questions. My goal is to actually take questions along the way and not leave them till the end. So if there's a question that's really relevant to the current discussion, I would actually be very happy to jump into the audience Q&A. So please keep those questions coming. So as a kickoff, right, right off the bat, it's a no-brainer that we are in a very difficult time, especially for tech. I think more so for companies that are fundraising. So I like the perspective, right, from each of you, right, from a platform standpoint, founder standpoint, and the VC standpoint, right? Like, what are the biggest challenges that founders are going to be facing in the next 6 to 12 months? Specifically when it comes to fundraising, and what are some of the issues, right, that are particularly exacerbated by the upcoming recession? Whether it's coming or not, we're still not 100% sure, but how much worse is it going to be? Maybe Carlos, would you like to kick it off since you have the investor hat over here?
Sure. Yeah. Maybe just one quick one from me. I think, one of the biggest challenges, even before the kind of looming recession, has been the balancing act for founders with fundraising and running the business, right? Fundraising is a full-time job in itself. Many could say, finding the right investors is a nightmare. Scheduling the meetings, getting the pitch right, getting your deck together, dealing with the rejection, which is going to happen for all of you, and you're going to hear it over and over and again. You're going to hear a lot of no's before you hear some yeses, and it's all super tiring, right? And we acknowledge that. And I think that this environment just obviously exacerbates the fact that many businesses are obviously operating in very challenging conditions at the moment. Both from the operating side as well as the fundraising side, which makes the balancing act even that more tricky. So I'll start off with that.
Great. Okay, that's really helpful. Charlotte, you want to take the next part?
Yes, definitely resonating with everything Carlos is saying. I think one of the challenges as a founder at the moment is filtering the noise. There's a lot of information, there's a lot of perspectives and points of view, and the noise has been, for me, similar now than it was sort of end of last year as well. And my approach to it has really, to apply a simple heuristic model, which is that good companies may not get funded during this period because it's tighter, but great companies will still get funded. And as a founder, I still want to build a great company. Good is not good enough. And I think for me, the standard has always been the same, but now going to market, I think we need to think more about what our competitive edge and positioning is going to be that's even more unique, and why the why now is even more important. So there are many different factors, but I would stick to that heuristic of great companies will still get funded. And another one, which is, high growth and moderate burn will still get funded. So still, focusing on the fundamentals and basics to filter out the noise and not panic, which is what I've seen within the founder community as well. Yeah.
Okay, so for Carlos, it's really all about the balance, right? The founder balance between fundraising and operating the business. For you, it's about filtering the noise and make sure you maintain a good balance between high growth and low burn. Jason, what are you seeing on your side?
Yeah, so I'll leave my founder stuff out of it because I think Charlotte did a wonderful job there, and I would echo those things. So from a platform perspective, it's more about your raise strategy is more difficult, unfortunately, than usual, and securing funding is more difficult than usual. So some of the key components of that are, you might have done an equity round, maybe now you're doing a safe, but what is a safe? How does that? So how do they work? What's a cap, what's a discount? So now you need to understand these things. And then who will lead and what does that mean? So there's some difficulties around, what is a safe? So you need to get across those definitely. Planning how much to raise, do you try and quickly get around now because things might get worse, or do you try and last as long as you can because things might get better? So that strategy is tricky at the moment, I think. What valuation will you get? I still see on Twitter people going out with the same valuation from 2021, which I think just must be those founders should not be getting money. They're going to be cut first. But I think we're probably all guilty of that to some degree as founders because, you're trying to find the balance. And so, getting back to the platform position, what valuation will you get? How long will your round take? A round normally takes 3 to 6 months. If your runway is less than 12 months, should you be starting to raise now, probably. And then should you be doing an inside round? So should you be looking to your current cap table as opposed to going out to new investors? So all these sort of considerations, I think, come into your raise strategy and making sure that you can secure the funding that you need to survive.
Yeah. So wow, Jason, I mean, you've given, in a good way, right? A lot of more questions and issues, right, with regards to this problem than actual solutions, because it is a complex problem, right? I hope to be able to address some of them. But Charlotte, I understand you fundraised just recently. We were having a conversation earlier. You did your pre-seed sometime around Q3 last year, and then late last year you had a angel round. You were doing a rolling close. Could you share a bit more, with a bit more detail, right? What was, and in fact, in relation to Jason, right? What was your strategy to fundraising then? How were you overcoming some of the challenges that you raised? And what unique maybe ways you did, right, compared to maybe your batchmates at Entrepreneur First?
Okay. The strategy was to look at all of the tweet storms from VC partners and try to piece together all of the different tactics that we could use. And
that's so funny. I have to jump in. We got funded from a tweet. It was so crazy. Like, we literally met our lead investor on Twitter, like not exactly, but like we saw the thread and we saw the interest and we chased, and like, so yeah, definitely use Twitter. Like it's such a great way to get your finger on the pulse, isn't it?
Yeah, quick digress, right? Twitter apparently, spending time on Twitter apparently does work. Carlos, are you on Twitter? Are you active on Twitter?
I'm not, no.
Yeah, so I completely
I might be
I'm
the exception to the rule though, but yeah.
It feels like most of the US VCs are active on Twitter, but the ones in Asia maybe not so much. But okay, let's circle back to Charlotte,
Let's come back.
with respect,
So just adding to that very quickly, I had a friend who got a check from Instagram Direct, but anyway, coming back to the strategy, so there were a few that were out there that we tried, right? Like building up our angel round to extend the runway to get enough traction to then go to market. So it was sort of like, how much do we need to get on a trajectory and then start raising seed? And once we even just started to inch up to that trajectory, I was really aggressively talking to investors, because then we had something very material to go and pitch. And I think that was the difference on like pre-seed to seed.
And roughly when was this?
This was sort of towards the end of last year.
Okay.
Yeah.
So we hadn't fully hit like the stock market crash and the war hadn't started. So things were still looking fairly optimistic, right? Yeah.
Things were, I mean, we had momentum definitely in the education technology sector, but the fundamental challenges are still there, and they're still there today. And the strategy we took was, extending our runway to get enough traction, because that was our main gap that investors were challenging us on. So figuring out what are your key gaps to cover those, and then not raising too big of a seed round initially. So we were going out with like a few $100K here and there. But then we landed an institutional investor who wanted to come in for a bit more. So then we decided to keep it open and keep it a rolling close so that we can shore up additional capital, which we did, just recently. So keeping it flexible, I think, what is the main message. That's the first thing. And second was, there was a lot of impression among sort of the seed stage companies that you shouldn't do an institutional round too early. Try to stick to safes and convertibles. But the opportunity came, and I was I wanted to take it. We found the right partner, and that alignment was really, really good for us. So we didn't listen to what the community was sort of advising, and just did our own thing. And I think as a founder, again, filtering the noise and listening to what's best for your company as well. Yeah.
Okay, no, that's really helpful, right? So you figured out what was right for yourself. You made the case, and you went with it, right, despite what everyone else was saying. So Carlos, on your end, right? I mean, clearly you meet founders pitching every day. You get decks coming in. In the last 6 to 12 months, right? And for you are more at the A and B level, so I would say slightly later stage. What has the expectation been from the founders, right, and the ecosystem? Has there already been do founders still expect VCs to move at the same pace? How do you think the fundraising cycle process among founders has evolved and changed over the last 6 to 9 months? Could you just give us a overview on that?
Sure. I would say the last 6 to 9 months, and then I'll kind of talk about in the context of us moving forward as well, like as we move through
that'll be
this
really helpful,
recession and everything. I think startups should be aware of kind of a few things with regards to the fundraising landscape. As mentioned earlier, we're all kind of aware of this potential recession that's like looming on the horizon. With it, things like rising interest rates are giving investors, other attractive options that are causing a lot of them, at least the ones we've talked to reduce their risk exposures accordingly. All exacerbated, obviously, by the war in Eastern Europe, global supply chain shocks, inflation rates that the developed world hasn't seen in nearly 50 years. So we're all dealing with these challenges, right? And I guess, what does this mean for the fundraising landscape recently and moving forward? I'd say, first of all, we expect to see the valuations come down. As Jason mentioned, with some founders being more realistic than others. But valuation multiples are tied to discount rates. So it's natural, right, that we'd see these valuations come down. The serious repricing, I think, is in part due to how newly public VC-backed companies have been performing over the past 6 to 12 months. I read recently that over 140 venture-backed companies that went public in the US since 2020 now have market caps that are lower than the amount of venture funding they've raised.
Oh, wow.
So just let that sink in for a sec. And of course, this includes our beloved Grab, but also companies like WeWork. I think many insurtech companies were lumped in there, like Oscar, a lot of mobility startups like Bird. So we've already seen this repricing kind of across the board with startups in the West, and then now it's starting to creep into Asia as well. And that's what we're seeing. And I think what comes with that is investors are now having more and more leverage over founders when negotiating term sheets. I think this is especially true when we're talking about, potential lead investors who are strategically placed, I guess, to really help startups grow and commercialize during these challenging times. But as Charlotte mentioned, I think now what we're seeing a lot from his investors is just going back to the basics, right? I think the days of growth at all costs are seemingly over. Startups that have been burning through cash thinking that they had easy access to cheap capital are now getting a pretty serious reality check, as investors are now focusing on companies that have built up war chests to fare well in this environment. And especially those that can actually pivot quickly to focus the business on profitability. I think that's starting to come into play. We've recently seen this play out in the grocery delivery space, for example, as many companies that were able to gain really impressive traction due to the pandemic lockdowns, but are now having to dig really deep to expand their margins. But with all that being said, I think even in this environment, we find areas that are ripe for disruption that can still support hyper growth companies, those great companies that Charlotte was talking about. On top of that, though, regional VCs have managed to raise massive amounts of capital recently. I'm sure you all saw the news about, Sequoia is raising 850 million for Southeast Asia. Jungle recently raising 600. Alpha raising, I think it was nearly 500. So there's a lot of dry powder out there looking for these great investments. And as VCs, as part of our process, we're obligated to deploy capital typically within the first 4 to 5 years of our fund's life. So this is a good thing for founders.
Yeah. So Carlos, can I ask a quick follow-up question before I want to jump to Jason, right, to dig deeper in some of the points you mentioned? But Carlos, are there particular verticals, in your opinion, that are maybe protected on some level, or do you think this entire repricing, this whole back to basics, profitability focus is across the board?
Well, I think the back to the basics and the repricing is happening across the board, because I think what's happening around the world is sparing very few verticals. But with that being said, there are some verticals that are a little bit more protected than others. I think one example would be, if we look at fintech, for example, right? I think one hand of it or one side of it is focusing on a lot of consumers and SMEs, things like lending companies, buy now, pay later,
Right.
insurtechs that are selling risk. These are the types of companies that would really struggle during a recessionary environment. But on the other side of fintech, we look at companies that are building infrastructure for enterprises and banks, and these seem pretty well placed to endure during this time. And I think that's because a lot of the big banks, really shored up their balance sheets over the past few years, and because of that, have been able to continue to spend on tech to remain competitive. So there's definitely some differences within verticals even.
Great. Thanks for that, Carlos. Jason, I want to jump back to you as a follow-up from the discussion earlier, right? Strategically, there are a lot of things to think about, right? But particularly if you're a founder today, right? Should you even bother fundraising if the ecosystem is, this bad, right? How should founders navigate that? Should they delay it by 3 months or 6 months and just completely stop with the fundraising process? Or do you think it's important to continue with that? That's the first part. Secondly, right, as a follow-up, right, you did mention safe notes a lot. If you could share a bit more, why a founder should be thinking about safe notes. What are some of the things to be thinking about when preparing for a safe note-centric round? Could you enlighten us on those two, please?
Yeah, absolutely. So I guess coming from two relevant positions here. So as a founder and a platform operator in this space, we're talking about this week in, week out with investors and with customers and our community. And the strong advice that's coming through to us is that you need to have 2 to 3 years worth of capital as a startup as soon as possible. Which means if you don't have it today, you want to have it next quarter. And you need, if you can't get it, you need a way to get to break even. There's a lot of talk about being default alive, which is talking about going back to basics. So somewhere between now and the foreseeable future, you have to be able to operate at break even, or so that's critical. And the advice is, and we don't know how long these things are going to last. We can only make the best decision we can make at the time, right? So we may turn out in 1 or 2 quarters time, some of these major indicators haven't turned out to be as bad as we thought, and things, the funding environment gets better. But as it stands today, the advice is plan for a very bad funding environment for an extended period. Get the funding you need right now in this quarter and then if you need to be cutting costs, you're cutting those costs. You're getting your business back into operating break even before you run out of money. So that's, I think, very good advice for anybody on the call. If you're not aware of that, we've been hearing that consistently and repeatedly. The second part around a safe note. So the two most common ways to raise capital is via equity. So new equity is created, normally about 20% for each round, and that would be a subscription agreement. And so new shares are created in the company, in exchange for the investment funds. Now that process requires more work, more cost, more time, and an actual valuation to occur. Now, to set a valuation in the current environment is very difficult. And Carlos will be able to talk this probably as well, but it's very, very hard for VCs, investors, to price a company in a very ambiguous market. We don't really know what's going to happen, and there's a lot of uncertainty. So to set a valuation for a price round is very difficult. So, the legal costs are greater, even getting access to investors, getting a lead investor, going around, getting all the other investors. You normally need to run a price round, like an equity round, all settles on the same day with the lawyers, through the lawyer's trust account, all this sort of stuff. It's just more difficult. So to get around a lot of those things, you can run a SAFE, which is a simple agreement for future equity. It's not really a loan technically, but it kind of looks and sort of feels a bit like a loan for those of you that aren't, so familiar with it. So what happens is you sign an agreement with the investors that, they give you the money and they get their equity in the future. Normally around the next round. So I won't go too much into the trigger events. There's a trigger event in the future. It's normally at the next funding round, then the safe investors will get a discount normally on that next round. For argument's sake, somewhere around 20% would be pretty standard. It can go all the way up to 0 depending on your negotiating capability, but so there'll be a discount and there'll be a cap. I'm getting a little bit technical here. I don't want to scare people. So safe note, the benefit of a safe note, really quickly, the benefits are you don't need a valuation. You don't have to close it all on the same date. You can have a rolling close, which can be really advantageous. We've got a lot on and it's a difficult market and it's hard to get access to investors. You can even do different terms with different investors if you want to, which again creates some other little problems, but getting money in the door is your core priority, you know, as a founder in a startup, right? So it's a lot more flexible. They're less costly. There's no valuation and they're a really good instrument and they're more or less globally accepted, a little bit less so in the UK because they've got some really good tax breaks. But yeah.
Yeah. So I think fundamentally here, right, like in this particular climate, the pricing of an investment is tricky because everything is so volatile, and it could work both ways, right? You could be massively underpricing yourself, and if for some reason the economy gets better and the recession doesn't happen, then you ended up selling yourself short, right? A safe note could technically help with that. So I think that's
Oh, sorry. Go ahead. So. The cap, like the valuation cap, can be a tricky one for founders. I've been over this so many times. I've talked to lots of different investors. Fortunately or unfortunately, investors sort of look at the cap as a quasi-valuation. So there does need to be some agreement on the right ballpark for your startup. So there is a little bit of evaluation that happens around that cap. What that means is investors, when they convert to equity, won't convert above the cap, right? So it is a bit of a quasi-valuation that does happen. And the second part I always warn founders about is not raising too much on a safe, because what happens if conditions get worse and you can never get 20 or 30 or 40 times revenue ever again? You know, that I don't think that's going to happen, but what happens if for the next 3 or 4 years you can't? So you do a safe and you raise, say, 2 million on a 10 million post safe, so that's about 20%, you think. But what happens if your next round is at 5 million or 6 million? You can really smash your cap table if you raise too much on a safe. So just be a little bit careful of the quantity that you're taking. And when you're looking at your next round and doing your modeling of your cap table, that you just keep that in mind, that if you don't get the right valuation on the next round, you can have a huge dilution from that safe investment.
Yeah. Okay. I want to move to the next part, and that's really about relationship building with investors. And most founders make the mistake of only doing that when they are fundraising, right? Which kind of like might put them short. And interestingly, this is also like a similar question posted by Dave, right? So I'm going to post what Dave mentioned to the group in terms of what are the best tips and channels to build and maintain healthy relationships with potential investors, right? And how much bad or good news should be shared with them. So we're going into the investor portion now. Maybe Charlotte, you want to kick this off? Like, how do you actually build relationships with potential investors, even your existing investors, right? And as per Dave's question, right, how do you maintain that balance between good news and bad news with them?
Okay, I'll answer the second one first, which is just leading with transparency, I think is the most important, because there's a lot of tactical stuff on Twitter, online as well, of, you know, how you can play the game. I'm not a big, I'm more of the other camp, which is build a great company, show the results, and then, you know, you have leverage, you have something that you can come to the table with. I do know founders that play the game, and that can get you into a sort of spider web of, you know, messy narratives, or sort of power tripping or power playing here, which can be unhealthy and also a waste of time. So honestly, I'd rather invest time in thinking about how I can solve this problem for my target customer, how we can make it a competitive solution, how can we expand our market, just strengthening our positioning as a company that has a massive opportunity to invest in. That's where I'd invest my time, rather than brand building, you know, my my founder brand per se. On the first question, around building potential relationships with investors, I think there is some merit to FOMO. There is some merit to it. I was initially, but the momentum, I think, is the aspect of FOMO that is effective, is when you go into market with some exciting data points to show, some exciting insights, you want to build momentum around this is an exciting opportunity, and shifting mindset as a founder from building product to I'm selling part of my company. This is a sales process. There will be a conversion rate. I think having that mindset of building relationships with these customers, right? I wouldn't invest too much time in having coffee chats or meeting with every analyst who reaches out to you on LinkedIn, because those are also the people perhaps that, you'll build long-term relationships with, but you also have to educate yourself as a founder as to what's their thesis, is the stage of their fund applicable to us? You don't want to be speaking to growth funds spending too much time with them early on, and when you're at pre-seed stage, it's not totally relevant. If they're not investing in education or they're not across different verticals for us, then maybe they're just curious or trying to fill up a quota. So some more kind of tactical things to keep in mind. But bringing this back to something practical for founders is just to be clear on who are the investors that have a thesis that aligns with yours, as well as the stage. What kind of ticket sizes are they, writing, and preparing that funnel and intentionally building relationships, not just meeting with everybody that reaches out to you. So just being focused. Yeah.
No, I completely get it, right? Like even for us at E27, when we used to do events, we used to be quite privy to make sure we matchmake companies that were of the right stage for the right investors. And even like during COVID, when we started to improve our investor profiles, the key thing was ensuring that founders were able to connect to the right investors, because the last thing you want is to connect to a really early stage investor, but you're raising an A round which they don't invest in, or even the opposite problem, right? It wastes time for everyone. It just doesn't make anyone look good in that process.
Yeah, that alignment is really important.
Yeah.
And leading with transparency about, I think it's especially with our existing investors, is maintaining relationship with them is, again, just being transparent about what the expectations are on you to update and provide information, and what cadences and frequency are they expecting, so that you can manage your time and energy as well. It's not infinite. So again, just coming at it from a time management prioritization standpoint, what's important.
Carlos, from your standpoint, could you maybe share like how some really good founders actually built relationships with you or Qualgro in general, and what did they really do right that impressed you all, that maybe eventually led to an investment?
Yeah, sure. I mean, I would echo what Charlotte said in that, I would lead with transparency. I think that's the most important part. You might think you're playing sly by, hiding some information, but eventually we're going to take a deeper, more responsible investors would take deeper dives, and it's all going to come out in the end. And we've seen deals fall apart at the final second because there was some piece of information that the founder was trying to withhold, and at the last second somebody dug it out in the data room, and the whole deal fell apart. And not only did the deal fall apart, but the relationship was ruined, right, between the investors and the founders. And as we all know, the tech and VC ecosystem in Southeast Asia is very small. And I think it's still nascent enough that, all the investors are still playing nice. We're still very collaborative. It's not Silicon Valley where we're trying to, rip each other's throats out. So news gets around really quick. And if you build a reputation with one VC, chances are news is going to spread, and it's going to sour. It's going to burn other bridges, basically. But if you're asking about what makes us decide or when to invest in startups, and talking about the process of that, I think that would be useful for some of these founders to hear about as well. While I would say there is a general process, I wouldn't say there's any fixed criteria as to why or when we invest in a startup. I think when deciding what makes a company investable, there's so many factors that come into play, right? It includes the team, the product, the addressable market size, competition traction, valuation, et cetera, et cetera. But the weightages of importance of these factors will vary depending on things like the company stage of growth or the industry, right? It's not an apples to apples thing for everybody. But in general, I would say most VCs, ourselves included, put the founders first. And I like to look for founders who are obviously smart and capable, founders that can surround themselves with the right people, build good teams, who are flexible enough to pivot if need be, who are what we call operationally scrappy, but don't like to leave a trail of destruction behind them. So there's a difference between scrappy and organized and scrappy and destructive. I like founders who I like to say are scratching an itch, right? Or solving a problem they've personally faced. This gives them a really deep understanding of their customers, and founders that have expertise in their given industries. I really like talking to founders who should be able to teach me things I never knew about their industries.
Nice.
And
that's a good point, right? Because they know their industry so well, right? If they were
exactly, I should be learning things on every call, that I've never heard before. Right. But we also look for founders, talking about relationships, that you can build strong and lasting relationships with. At the end of the day, the companies we invest in will be in this partnership together for a good 7, 8, maybe 10 years. So you can imagine why the quality of the relationship and having that chemistry really matters. But as far as the process, I think it would be useful for a lot of you to hear like how we look at investments and how we move along the kind of due diligence stages as well. I think obviously a lot of it differs from VC to VC, but at Qualgro, we do like to take a very methodical approach. Right. That focuses a lot on deep analysis. We like to build our conviction from the ground up. Typically, we'll meet with startups that obviously suit our mandate. So, finding the right investors to talk to, as Charlotte mentioned. And after a first intro call, we'll typically have a pretty good sense whether this is something we'd like to dig deeper into or not. We might do things like have an initial founder assessment, identify any red or green flags off the bat, as well as come up with a list of key questions that we'll want answered to determine whether we move on or not. If we like the answers we get to those key questions and the green flags outweigh the red flags, then we dive deeper. We do more technical analysis on the product, maybe do some site visits. We may do our own market sizing exercises, reference checks on the founders and key team members, customer interviews. We might do some risk return analysis models. And lastly, once all the information is collected, we typically organize it into what we call an IC memo, which is a document that we use during the IC or the investment committee. Investment committees at VCs are typically made up of the partners of the fund, maybe an advisor or two. And the investment committee basically makes the final decision whether to invest or not. It should be said that each VC has different IC dynamics, I would say, with some needing a unanimous vote between all the members. Some need only one key partner to decide. So it's different. And as founders, I think you should try to do your research and learn as much about the VCs you're going through this process with as possible. Because it may be important to understand, who the key decision makers are at each fund, as well as, what buttons you might want to press, to move forward. So the length of this process differs pretty vastly from VC to VC as well. Some only need a couple of days to make a decision. We've seen that happening a lot recently, but others can take, a month or longer before pulling the trigger.
Yeah. So I would like to post this to Jason and even Charlotte, right? And it's also a follow-up from a question from an attendee. And I've always seen this, like different founders do this differently. Once you establish a relationship with an investor, and typically you put them maybe on your newsletter or your email list, right? What kind of milestones or how would you think about with respect to what you should share with his or with him or her, right? This investor. Like, should you share deep financial milestones? Should you keep it to product milestones, or should you keep it to like high level achievements and wins that the companies are doing? Charlotte, if you do it already, would be great to hear, how you do yours. Jason, likewise for you, right? If you've seen good founders do this, how do they do it well?
Do you mean for existing or potential?
Existing. So investors that you're already talking to,
Right.
so they could invest at a later stage.
Right.
Yeah, and also existing, right?
Okay. Yeah. For potential, if I'm not in fundraising mode, I'm not really actively having those conversations, because when I was in fundraising mode, 100% of my time was on fundraising. And there again is that balance that Carlos was talking about between building the company and the product and raising funds. And so when I was fundraising, I had to hire a product manager just to take over my role just for that period. And yeah, I found it very hard to try and do it 50-50. That was just how I did it, was, try to focus 100%, set a deadline. We start fundraising on this day, this is how much we're raising, and we're closing on this date, or we're rolling and this is how much, and in existing investors, you were pretty transparent with our investor update about, we have a good news and bad news section. There's always a bad news section, because if you brought on the right partners, they should be able to help you with that section, whether it's introductions or whether it's, value add. And in some way, you should be able to talk to them about the challenges that you're facing, because they've already invested in you. So invested in the journey. I think one thing that I learned in this process was also how much does that institutional partner have on the cap table as well, could determine their involvement in your company, versus if you're working with much bigger funds and larger portfolios, perhaps not being able to lean or expect that much help from them. That was something that I had sort of observed. Yeah.
Interesting. Okay. Jason?
Yeah, from my side, I think, going back to the poll at the beginning, getting investor relationships, building them, getting meetings was the number one problem people, highlighted. So I think such a critical thing. I've put in the link in the chat here, a link to a capital raising toolkit that I built, which has got so much capital raising resources in it, years of research from me all in one place. So I highly recommend you all copying that and checking it out. And in that toolkit, there is quite a lot of real estate dedicated to exactly this topic. There's things from finding the right investors, actually just talking to the right ones, as Charlotte said before, just getting in the right room is very important. There's a page in there about be a line, not a dot, right? No investor is going to give you money the first time they meet you. Certainly, investors can have a thesis and you can fit perfectly in that thesis, and you might get a really, really quick round done under some circumstances, but that's not the norm. You shouldn't expect that. You should expect to have the first meeting, and you need to have multiple touch points. That's what I mean. The first meeting is a dot. No one's going to give you any money. You need to draw a line for them from where you started to where you are now. And that's, building the relationship. It shows, that you execute. It shows that you're thinking correctly. It shows that you've overcome challenges. And I guess that comes, there's another page in here around, I think it's in that same tab, be a line, not a dot. I shared, so Michael Batko, one of the greatest minds in Australian startups, the CEO of StartMate, he has a template that you can use. It's called the Good, Bad, Ugly Update. So we do that every month. We've got an existing investor version that goes out to our current cap table, and I've got a slightly, adjusted version that I send more widely, because I don't think it's cool to send like everything to people, when they're a little bit more disconnected from the company. But in the internal one, we put our revenue, how much we've burnt, we put our runway, we put all the core financial information in that. We've got, some high level stuff to keep everyone excited and connected to the mission. And we've got a bad and an ugly section, because I think it is important. You're a startup, right? You're going to be making mistakes. You're going to be not knowing how to solve things. And by being able to show that you can share that, be transparent, but overcome those challenges as well. Like if they sit there month after month after month, that's probably not a good sign. You need to be able to show that you can overcome them. And some might, like we've had data problems for like a year, and I used to hate doing my monthly update and having it there. Like it used to just stress me out so much, but we have eventually overcome like some of those. It's just so hard to get good data in a SaaS, but there's other ones in there like so the good, bad, ugly I think is a good template. I think
I'm trying to look for it, so if you could share it later, that'll be helpful.
Yeah.
And then Carlos, on your end, right, like who are some of the, okay, let's forget the good ones, right? Tell us some really bad ones that you've seen, right, from an update standpoint, or and then of course ideally you fix it and work with them to fix it along the way. But what would be considered a really bad way to update your investors?
That's an interesting question. I honestly haven't seen that many bad ones, as long as they're fully transparent. I think as both Charlotte and Jason mentioned, we appreciate the fact that you're willing to share even the bad and ugly pieces of news, because that's what we're here to do, right? We're here to help. We're partners, as we like to put it. And I think there's two components when founders create term sheets with VCs, right? When we do the investments, first is on economics, so all the monetary stuff, the financial stuff, and then the second is control. So it's all about economics and control. And the control part is really, I think, the key here, because when you sign these contracts with investors, you are giving them some control of your company. It depends on obviously the kinds of shares that they have and the amount of equity they own in your company. And because of this, I think giving us the proper updates to be able to use our control for the better of the company is really, really important.
Right. Right. I'm actually looking at the update that Charlotte just shared. The one on the one by Almanac, and I think it's really good how they've structured KPIs, good news, bad news, and stuff like that. So we see if I can make some copies or references for my own investor updates. Okay.
I'm not sure if you guys have seen, just quickly, sorry, they have a stat on their website that says companies that do updates are. So I think that works in two parts. It shows that you're a better founder, you communicate better, you can do your monthly work that you need to get done. Plus also the relationship is stronger. Your investors are more connected. They've been able to be with you on the journey. So I don't know if the 3 times thing, I don't know how statistically proven that is, but certainly I think it's a strong indication of why you would do it. Nice.
Okay. I think that's a really helpful tip and advice. And it's always good to be accountable, right, to someone and do it, whether is it almost at the end of the session. I just want to answer a quick question by one of the attendees, right? So this will be a quick one before we go into closing. Is business valuation more important than fundraising? So this is something that Bala asked. Any quick thoughts on this? Is business valuation more important than fundraising? More important in fundraising? And depending if you're doing a safe note or a price round, right? Does that how much does that matter and when?
I think it's critical because how much your company is valued at essentially determines how much capital you can raise. So, for example, if your company's worth 10 million, let's just use round numbers. It's worth 10 million and you raise 2 million, that's a 20% dilution. But if it's worth 20 million and you raise 2 million, that's a 10% dilution. So the valuation of your company is critical because it determines how much dilution you get for the amount of capital you need to raise. When it comes to a safe, essentially you're kicking the valuation down the road until the next round because you're not doing an actual valuation on the round, but at the same time, the valuation cap certainly gives you a major valuation mechanism that you need to be aware of. So it's also quite a strong and important valuation point that you need to take into account. So similarly, $2 million on a 20 million cap is a lot better than $2 million on a 10 million cap. So yeah, really important. So the better valuation you can get, but you also want it to be balanced. And I think a lot of people are paying the price from having very, very high valuation last year. And so now they're looking at challenges off the back of that. So we've always been trying to have a good valuation so that the existing shareholders can be rewarded for the success that you've had, but always having a nice balance so that you can achieve a better valuation in future years.
Got it. Okay. I'm mindful of time, so I think we need to do the closing. So as I mentioned earlier, right, I asked all of you to prepare one kind of like closing statement or like a takeaway for everyone. So maybe we'll start with Charlotte, right? What is one key advice or closing or call to action, right? You would advise everyone to take, whether it's a book, podcast, video, long form article, to help them in this fundraising and investor relationship building process.
Sure. I would add one thing onto what Jason said about valuation is that at the time that we were negotiating our valuation, there was sort of, you're looking at like 1 to 2 or even 3% delta either way on the valuation on the cap table. And you have to take a long-term view. I think when we took a short-term view, I was like, oh, that's like, quite a bit of dilution. But if taking a long-term view and the timing is right and the partner is right, having that humility to say, we're on a long-term journey here, and it's a win-win if you've got the right partner. My key takeaway or to offer would be to build a community of mentors who are different stakeholders in this ecosystem that can give you different perspectives and information so that you can filter your own noise. That would be my main takeaway. So having friends or mentors as investors and institutional investors, angel investors, fellow founders at pre-seed, seed, even A stage, incubators and accelerators, and just having a pulse on the market. It's your responsibility as a founder to be able to come to the table with all the information you need to make the right decisions. So just taking that extreme ownership, building that community for yourself.
Lovely. Thanks for that, Charlotte. Carlos?
Yeah, for me, I guess a piece of advice that I might give, I think we talked earlier about like verticals and trends, and I think there's a lot of kind of pressure for a lot of founders to chase these trends these days. And I think I would tell founders, not to fall into this trap of getting kind of tunnel vision, and just being, I guess, more aware of how the broader market is behaving. Maybe, what are some of the macro kind of tailwinds and headwinds you'd be facing? What is happening in the capital markets? How are your customers behaving today? What's going on with the labor markets? We know a lot of founders who are having trouble hiring quality developers these days. What are some of the risks to your margins? These are all things you have to think about without kind of having paralysis by analysis. But I think having a good sense of these things will allow you to make better business decisions in whatever industry you're in. And as far as another takeaway you mentioned earlier, Mohan, it might be helpful to recommend a book or a podcast. I think for a lot of founders who are looking to build or raise from VC and build relationships with VCs, a good book would be The Secrets of Sand Hill Road by Scott Kapoor, who is one of the managing partners at Andreessen Horowitz, one of the most esteemed kind of VCs in the world. That one has really good tips. As far as podcasts, I listened to this one called This Week in Startups. It's hosted by Jason Calacanis, who's kind of a Silicon Valley veteran. He can be a bit controversial, I think, in some of his takes, but he gives pretty entertaining takes at the very least on kind of the startup current events.
I would completely agree with you. Controversial, but very entertaining. Yes.
He's also our lead investor. So, just to wrap up for me, so like no two raises are the same. I'm a bit amazed how difficult and different all raises are, and there's no right and wrong way to do a raise, but there are a lot of lessons you can learn. There definitely is a lot of things you shouldn't do, and there's a lot of hacks. So I've put in the chat here a link to a capital raising toolkit. It's got a ton of hacks and processes and guides. They're all designed to save you time, to take like a 3-month raise, and get it done in half the time. So I think it's a wonderful resource. We've been honing it over, 12 to 18 months. So please do check that out. Obviously, Cake is a platform that helps streamline capital raising, cap tables, and ESOPs. So I'd be remiss if not just mentioning that. It does have safe agreements built in. It has subscription agreement built in. It has a whole sending and signing workflow. Share certificates are automatically issued. So as a founder or a CFO at a startup, it's going to save you a lot of mucking around, and we all need every advantage we can get. So I always recommend that, but no hard sale from me. But it is probably pretty helpful.
Nice. Great. Okay. Thanks a lot for the session. I think I've learned a lot myself. And clearly,
thanks everyone.
Fundraising isn't an easy task, but you got to keep your eye on the ball, not get distracted by what's out there. And at the end of the day, right, really make sure that you do what's best for your company and don't just necessarily follow what the herd says. So I'll hand this back to Joel. All yours, Joel.
All right. Yeah, thank you so much. Thank you so much for Mohan for leading this wonderful conversation and also for getting a recap of everything that we've discussed. Thank you also to our panelists, to Jason, Carlos, and Charlotte for the very insightful discussion and for sharing all of these resources that our audiences can use. So I'm pretty sure everyone here have learned a lot. I even took some notes of my own, so I do hope that everyone also jot down some notes. And of course, this event wouldn't have been possible without our friends from Cake Equity. And it doesn't end here. So before you guys go, I know we are at time, echoing what we have heard earlier. If you're interested to test and experience what Cake Equity has been baking, they're giving away free cakes, as they call it, for the first 5 investors. So feel free to scan the QR code here or click on the link on your chat here. Jason, would you like to share some thoughts on this one?
Yeah, exactly. So like first 5 investors free. So you can spin up a raise. You can literally use our safe templates. We've got them for about 10 countries. So you can set up a raise. The safe agreement will be right there. You can send and sign, 5 safes before you even have to pay us. So it is going to save you a bunch of time and money. If you've already got your own lawyer, you can bring them in, use their templates. So look, it's massively helpful. If you need help getting set up, we've got a customer success team that are experts that are gonna really help you, and you really do need every bit of help you can get when you're raising. So please do lean on us. And good luck with your fundraising. We're all doing it, so let's help each other.
Awesome. Thank you so much for that, Jason. So once again, everyone, first 5 investors. So sign up now. Feel free to scan on the QR code or click on the link in the chat below. And as always, we have more of these episodes happening in the future, so stay tuned. And you can know more about the upcoming ones, as well as the other events and programs happening around the region that you may be keen on joining at e27.co/events, or by signing up for an E27 account to get updated with the daily digest. So once again, everyone, thank you so much for attending. Thank you so much to our panelists and our moderator for the very insightful discussion. And as always, stay safe and stay sweet. Bye, everyone.
Bye. Thanks, Joel. You're a legend.
Thank you. Bye-bye.
Thanks, everyone.
See you
Bye.
all.